Namaste, everyone. Welcome to this sixth webinar of Direct Tax Committee jointly with Income Tax Department. Very good evening to all of you. Today we have Sri Prakash Dubey ji, who is a Principal Commissioner of Income Tax. He's from Delhi. We also have today CA Vishnu Agrawal ji, our Vice Chairman of Direct Tax Committee. Then we also have CA Manoj Gupta ji, who is going to take us through capital gains and corporate restructuring provisions under the new Income Tax Act 2025. In absentia, Piyush Chhajer ji, Chairman of Direct Tax Committee, and all the respected members, those who have joined across the India. Very good evening to all of you. Namaskar. Friends, as you are aware that Institute of Chartered Accountants of India is always in forefront whenever there is a change in the new law is introduced by our government of India. Our institute is always at the forefront, and whatever best initiatives we can take, we are taking. So to take that forward, be it income tax, be it GST, be it insolvency and bankruptcy code, be it new labor codes, our institute is there and is contributing for betterment and nation development process. Today, this is a sixth webinar where institute is jointly working on various new provisions which are there on new income tax code 20, new income tax act 2025. Friends, we are here today on 15th of January. In next 15 days, new budget of 2026 will also be there. So we are really eager to understand the opportunity of new income tax act is knocking the door as a chartered accountant, and income tax department is also working really hard to reach out to the maximum number of members of Chartered Accountant Institute, as well as the business houses, the individuals, and the taxpayers. So, to take that forward, today we have all the learned, distinguished uh, personalities from Institute, from Income Tax Department, who will be discussing with us. So, to start with that, today, unfortunately, Piyush Chajar sir could not join. He had a flight to catch, so he could not join. Uh, Nevertheless, we have another dynamic Central Council member who has served WIRC, Western India Regional Council, for 9 consecutive years. He was also a chairman at WIRC, and he has been a very uh, uh, what we can say a fantastic experience in income tax. He is working in the arena of search and survey procedures, Benami, black money proceedings, IT-80 proceedings, and income tax litigation. So we have a wonderful team of direct tax chairman Piyush Chajar sir, as well as vice chairman Vishnu Kumar Agrawal ji. So without further wasting time, I'll request Vishnu Agrawal sir to please give a opening remarks to this wonderful sixth webinar organized by Institute of
Thank
Chartered
you, Abhishek
Accountants of
Bhai.
India.
Thank
Yeah.
you, Abhishek Bhai. Honorable Principal Commissioner of Income Tax Exemption, Sri Prakash Dubey ji from Delhi. Our learned speaker, Manoj Gupta ji from Jodhpur. The Regional Council member and today's moderator for this particular program, Sri C.A. Abhishek Damne from Pune. All my esteemed colleagues, senior in the profession, ladies and gentlemen. First, I wish very happy Makar Sankranti to each one of you, friends. This is the sixth webinar jointly with the Income Tax Department under the New Income Tax Act 2025. New Income Tax Act 2025 begins with the 1st April 2026. APJ Abdul Kalam always says that chartered accountant is a part of the nation building. Friends, with this line, we are always helping hand to the government, and we are bridge between the government and the taxpayer. So it is our duty to educate by each and every chartered accountant, every taxpayer for the Income Tax Act 2025. Friends, we have done so many physical programs across the country, in the study circle also, in the my branches also, each and every branch on each and every regional council has done so many programs to reach out to my each and every chartered accountant about the new Income Tax Act 2025. Before 1/4/2026, the new Income Tax Act 2025 take place on the table. Friends, my each and every chartered accountant and the taxpayer must know what is the changes in the new Income Tax Act. Friends, with this line, we are again joining hand with the Income Tax Department, and Income Tax Department is kind enough to give their logos also, and also we are doing the joint program with the Income Tax Department. Not only we are doing this webinar, but also my each and every branches and my regional council is also doing so many programs with their local income tax department. Friends, my best wishes with you, and I hope this Income Tax Act 2025 begin from 1/4/2026 will be reach out with each and every members. With these words, I thanks to each one of you, and especially thanks to Prakash Dubeji for joining this particular webinar for benefit of my each and every chartered accountant. Thank you, friends.
Yeah. Thank you, Vishnu sir. You are ably leading our direct tax committee in the right direction, and the efforts are really seen. So today we have Shri Prakash Dubeji, who would be he's a uh, principal commissioner at principal commissioner of income tax exemption. He's heading right now. He's having jurisdiction of Delhi. I would like to take this opportunity to briefly introduce Shri Prakash Dubeji. He's a commerce graduate from the University of Kolkata, and said he was also a student of Saint Xavier's College in Kolkata. He is a 2001 batch senior officer, having experience in the field of taxation, income tax, wealth tax, and all the related to Benami, black money. He has put very wonderful and varied experience in that field. During his service, he has handled various important financial investigation of large corporates, mainly banking, insurance, the manufacturing companies, mutual fund companies. He has handled, and he has ably handled with that as a income tax department representative. He is also empaneled as a joint secretary to the government of India, and he is currently holding post of Commissioner of Income Tax in Exemption Department, as we have already discussed. He has been a trainer to a National Academy of Direct Tax in Nagpur. He has handled 4 batches where training of the government officers happens there. He has wide experience in the tax administration, optimization, and augmentation of the revenue collection of Government of India. He's been instrumental in making systematic changes and setting up of institutional mechanisms for efficient and effective administrative. So, who else we can have a better speaker today when the new Income Tax Act is knocking the doors of and it will be enacted from 1st April 2025. So I'll welcome on the platform of ICA on behalf of Direct Tax Committee, Sri Prakash Dubeji. Sir, thank you for joining us, and I hand it over to you for your opening remarks.
Thank you, Abhishek ji. And I'm really grateful to Vishnu ji and Manoj Gupta ji. Manoj Gupta ji, because he is going to take the session for the day. Vishnu ji had very nice words for me to say, including Abhishek. I'm really grateful and thank you. I'm grateful to the Chartered Account Institute of Chartered Accountants in India, that they are taking up this effort to actually upgrade and make the professionals aware about the new tax code. Now, obviously, these sessions, series and sessions would be upgrading all of you on the provisions of the new tax codes. But I'll briefly tell you something, that the new tax code is not just a new tax code, but for us countrymen, it is a matter of great pride, and why I'll come to it subsequently. It's, as far as the law is concerned, rest assured, I think there's no change in the law per se. The law before the new tax code remains exactly the same, which is post new tax code. But what is the reason for pride is something which we should take out time and try to understand. Now, we are not the first country which has tried to simplify tax codes. Taxation is a complicated area, a fiscal matter, but and it undergoes changes every year. Not only in our country, almost every country undergoes changes in the tax laws very frequently compared to any other law. And that makes the entire law and legislation very complicated because it has to be always contemporary. Now, given that we keep on changing over the years, but then we make the same change in the same book. Do you understand that? If you have a diary where you are noting everything at one page, what will happen to that page, say, after a gap of 2 years or 3 years, if you are noting on the same page? It will look very messy. And it will not only look messy, after 3 years, when you try to read it, you will also not be able to make head and tail out of it. It also looks very complicated, becomes complicated. This is where I would like to compare ourselves with other countries like UK and Australia. They've all tried and they've tried and they started much earlier than us. They were well ahead in time on actually taking up the simplification matter. But for example, UK, when they started their simplification sometime in 2004, they took 14 years. And what was the outcome of the simplification? That their tax code volume went up 4 times. And not only this volume went up 4 times, the number of acts that govern taxation, they from 4 they went up to 14 or 15 laws. I may not be exactly knowing the exact figure, but this is how they simplified. By from 4 acts they went to 14 acts. From say 900 pages they went to around 1200, 1400 pages of the law, and they did that in 14 years. Australia is another example which has actually done simplification of its tax codes on a massive scale, and they have achieved also something similar to UK only. After an effort of 4 or 5 years, their tax code has increased, has at least become double in volume. Compared to that, we've been able to simplify our tax code in exactly 7.5 months. And that is a matter of pride. And that is the effort which the government has taken. And all of us, irrespective of whether it is the income tax department or it is the Ministry of Finance or the chartered accountants or people at large, as a country, we should celebrate an effort like this. And we should also tell people that this is something which has been achieved, which is not only marvelous, it is one of its kind in the world. So we've done it in 7.5 months. Our word count has halved. Our volume actually has halved. Means if you see the word count in the old tax code, it was around 5 lakh words, 5 lakh plus words. In the new tax code, it is 2.5 lakh, approximately around that. So actually the word count has come down. People may think that the volume of the book has decreased because the font size has been reduced. Now that is an impression which I have seen, that many people very loosely, when they talk about the new tax code, they somehow mention this, that you can do that by reducing the font size as well. But that is what I want you all to understand, that it is not done by reducing the font size. We have actually been able to achieve something which we ourselves, after achieving it, find very awe-inspiring. Now, the number of sections have come down. The number of pages have gone down. The volume has gone down. But that is not simplification. When something looks sleek, definitely it is one way of looking at it as simple. But apart from that, if you see the provisions, like from the perspective of, say, fringe, if you, most of you would have known about fringe benefit tax, isn't it? It was something which had been done away with in 2010, and it still occupied 20 pages in the act. So all these sections have now been removed. The act is not redundant in any way. No provision of the act is a redundant provision. You don't have to look for the correct position or the right provision in the haystack of redundant provisions. The second thing which has happened is, like, the act now uses the language which is the language which is normally understood by people. So a very simple thing like notwithstanding has been replaced with in spite of. So when we talk in a way, if the code is also in the same way, the spirit of the code will match with the spirit of our discussions also. So that is the belief with which the language has been simplified. Now, a normal, common layman who does not have 30 years, 40 years experience in taxation can also read it and reasonably understand what does it mean. Apart from that, if you see the formulations wherever the computations are mentioned, so if somebody has ever remembers how we used to read formulas in maths and physics. So the formula is just given with symbols, and the symbols are then clarified at the bottom. So it makes the computation very easy to understand. If you see the old code, everything was written in paraphrasing. It was paraphrased and written, and and the paragraphs were like 2-page long paragraphs. So by the time we reached the end of the para, we forgot what was in the beginning, and it's very difficult to actually make head and tail out of it. But now in this form part, a formula part, it's very easy to understand. The most of the portions where you don't need to apply mind, it is more like scientific, putting x plus y is equal to z. X is this, Y is this, and Z is this. That not only has reduced the word count, it has also made it very simple to understand. You will also find that, interestingly, I don't know if any other country has tried this with this as an experiment. Tables are now part of the statute. So if in exemption, if you see in exemption, there are 14 different reasons and different forms for applying for exemption or registration. Different forms, but you can see the entire set in one page in a tabular form, and that helps you to understand that which is the right place to go. Instead of, if you have to read it the way it was earlier, then many people we've seen, they don't understand where is the right place, which is the right section under which I should apply. So that is another addition that has happened. And last but not the least is that it has now been streamlined. So all of you will understand when we talk about assessment of partnership firms in the old tax code, I don't see any chapter in the old tax code which talks about assessment of partnership firms. So you'll have to pick somewhere in the business section, then section 186. It's spread all over the act. And that is why most of the books, Mr. Singhania's book used to sell most because of this chapter, because you could find everything on one page or one chapter on assessment of. But now this has been taken care of in the new tax code. As far as exemption is concerned, you will see there's one chapter, chapter 3, and from registration to computation to exit tax consequences, everything is there in one chapter, and it is arranged, even the definitions is in the same chapter, and it is arranged very sequentially as a flow. So you enter, before you enter, you should know the definitions, then you register, and then you compute, you file your returns, and finally when you want to exit, this is the way you have to exit. All this is in one place, and this is true for every chapter and every section of the act. Now, why I've been allotted 10 minutes, but I think I overshot by a minute or two. But the reason is that
No, please
there
continue,
are
sir. No problem. Please
there are
continue.
very few occasions in the legislation, field of legislation and policy making, where I have seen in my 25 years that we get a moment to just watch what we have done and rejoice. This is one moment which I want all of you to rejoice, celebrate, and be proud of it. It is not done by a department. It is not done by a profession. It is an act which is done by the country. And as countrymen, we should all be proud of it. I'm sure Manoj will take you through with the nitty-gritties of the provisions. But as I said, it will be a very easy task for him, because he just has to tell you what is now, where it was earlier and where it is now, and that will take care of your upgrading. That's all from me. Thank you for calling me, and I hope I have not overshot my time. Thank you so much.
Thank you so much, sir, for your wonderful address. You gave entire synopsis how UK, how Australia implemented the simplification, and how in shorter time, in less than 7.5 months, India adopted to the new Income Tax Act. Thank you so much, sir, for sharing your views about the word count also, which has been reduced. The normally uh, used phrases have been changed for simplification. The tables are part of the act, the streamlining overall. And you are right that the countrymen should be proud of this very valid achievement of Income Tax Department, the Ministry of Finance, as well as the Chartered Accountants. And it is time to rejoice that. Thank you so much, sir, for your valuable time and sharing your wonderful views with that. We will proceed further for the main topic today, which is about the capital gain and corporate restructuring. For that, it will be taken by none other than Manoj Gupta ji, who is a chartered accountant having experience of more than 30 years now. He is currently a special invitee at Direct Tax Committee, New Delhi of ICAI. He has been a very avid reader. He's been writing also a lot of articles, a lot of books. So he is a contributor to uh, 6 books that I would like to read out those books. I'm sure many of you are aware and using those books. Direct Tax Ready Referencer 2023 handling. He has also authored Handling of Tax Audit, Capital Gain Taxation, Income Tax Practice, Handling of Notices under Income Tax Act, the Tax Planning Ideas. So all those books are to his credit, and we have a wonderful faculty here today to guide us through what are the provisions of capital gain and corporate restructuring. So I'll request Manoj ji to please take this session forward and share your presentation as well.
Thank you, Abhishek ji. Thank you, Tax Committee, for inviting me. Vice Chairman Vishnu Agrawal ji, Shri Prakash Dubey sir from Income Tax Department, and other participants, members of Tax Committee. We are here to discuss about the capital gains taxation provisions under the new Income Tax Act 2025. I have read the entire new act almost, and I will go with the words of Sir Prakash Dubey sir, that simplification is not the only thing. The arrangement is also a great thing. We have exemptions now divided in schedules. Fully exempt incomes, non-resident के exemption एक जगह list, they have listed non-resident exemption at one place. They have listed exempt incomes at one place. They have listed certain specific exemptions at one place. So 5-6 schedules they have made. And chapter 3rd in specific charitable trust. That's a great achievement that you have put it at one place. Entire law is now, you can read simple section 375 or so from onwards, and you can find the entire law there. Need not to go here and there. Everything is there. Definitions are there. Conditions are there. Everything is there. So till now we had a problem of chartered accountants getting confused because of where it is written in the law. Now it is written at the one place. So you have to simply tell him, I receive many queries on a daily basis, WhatsApp or phone call, that is, where to find this provision. Now you have to tell him, just read that chapter, you will get entire thing at one place. So that is the one thing. Second thing is simplification, or not only tabulation, but also the formulation. They have given formulas everywhere. Like I would like to give one example, that the animal property acquired before 23 July 2024 is eligible for indexation only for the purpose of computation of tax. Now you have to compare the tax under the current law. People are confusing with the language. Now they have given a formula there. You put that values in the formula and you will find what amount of tax has to be Okay. So this is a very great way of communication and a new way of drafting the law. For the first time, I think so, in any law, there would have been used tabulations like a book. So I would start with sharing my presentation. I think it is visible. Not visible?
It is loading, sir. It is loading. Yeah.
Where number 1, number 2, number 3?
So please press F5 button. Yeah.
Okay. Basically, if we talk about capital gains taxation, there has hardly been any change except the redundant provisions have been removed. They have retained the law as it is. Section numbers has to be changed. Language has been simplified. Notwithstanding is the most notorious word in the legal field is now been done away with. So first we deal with capital asset. Definition is same as given in section 214 as of now. Property of any kind held by an SSC, whether or not characterized as business or profession, securities held by FIIs, investment fund, unit linked insurance policy on which exemption is not available, और एनी अदर पॉलिसीज जो वो 2.5 लाख 5 लाख वाली है उनमें भी जो है ये कैपिटल गेन्स का दे विल गिव सम बेनिफिट टू यू. Stock and trade excluded पहले भी it was earlier there, now also there, but commercial effects excluded है. Agricultural land in India in the same fashion it is excluded. Today gold deposit bonds are excluded. Personal effects other than jewelry are excluded. Jewelry, archaeological collections, drawings, paintings, sculptures, work of any art. So these are the definitions very much same, similar to the current definition. There is hardly any change. Now next is transfer, the same thing. Section is changed, but rest is same. It is inclusive definition, sale, exchange, relinquishment, extinguishment, compulsory acquisition, conversion of asset into stock and trade, maturity redemption of zero coupon bond, transaction by becoming member of a society, part performance 53A. बलबीर सिंह मैंने सुप्रीम कोर्ट का केस ध्यान रखना पड़ेगा, वो पहले भी रखना था. और डिस्पोजिंग ऑफ पार्टिंग विद एसेट एक फॉरेन के लिए है. एक्सप्रेशन इमूवेबल प्रॉपर्टी फॉर द पर्पज ऑफ ट्रांसफर डिफाइन कर दिया है, डिफाइंड है, एंड इन दैट राइट्स इन लैंड्स एंड बिल्डिंग आर आल्सो इंक्लूडेड. नॉट रिगार्डेड एज ट्रांसफर एग्जेम्पशन है. All exemptions which are not regarded as transfer, we'll discuss some of the important. Similar, earlier distribution of capital asset on partial or total partition of individual family is exempt from capital gains tax. Transfer under a gift or will is exempt from tax. Transfer of a capital asset stock other than stock and trade by a company to its subsidiary company if parent company holds whole of the share capital, and subsidiary companies in Indian company. Similarly, transfer of capital asset not being stagnated by subsidiary holding whole of the share capital and the Indian holding company is Indian company. Business reorganization, the corporate restructuring, transfer of a capital asset in a scheme of amalgamation by amalgamated company to amalgamated company. If the amalgamated company is an Indian company, then it is exempt. Transfer by a shareholder in a scheme of amalgamation, shares का जो ट्रांसफर होता है, तो transfer is made in consideration of allotment of shares in the amalgamated company, and amalgamated company is an Indian company. There is an exemption that when the shareholder itself amalgamated company, so that exemption exception is still there. Business reorganization continued. Corporate restructuring, transfer a scheme of amalgamation of a capital asset being shares or shares held in an Indian company by amalgamating foreign company to amalgamated foreign company. Conditions that 25% of shareholders of amalgamating company continue to shareholders of amalgamated foreign company. Such transfer does not attract capital gains tax in the country in which amalgamating company is incorporated. Transfer in a scheme of amalgamation. Transfer in a demerger of a capital asset by demerged company to resulting company. Transfer of shares of resulting company in a scheme demerged share that is exempt again. Transfer in a demerger of a capital asset being shares held in Indian company by the demerged foreign company to the resulting foreign company. Here 75% value of shares and is the condition, not 25%. Transfer in a business reorganization of a capital asset by predecessor cooperative bank to successive cooperative bank. Transfer by a shareholder in a business reorganization of a capital asset being shares in predecessor cooperative bank to subsidiary cooperative bank. These are business reorganizations. Now NR to NR, non-resident to non-resident. Transfer of a capital asset being bonds or GDR made outside India by non-resident to another non-resident, then it is exempt from capital gains tax. Transfer of a capital asset made by non-resident recognized located in the International Financial Services Center, the gift city that in Ahmedabad. So is exempt if consideration for transfer is payable in foreign currency. Such capital gains is bond with debenture, a bond or GDR, rupee dominated bond, derivative versus other securities that will be notified. Non-residents, government security, relocation of MF, reallocation होता रहता है MF में. Consolidating scheme to consolidated scheme MF में. Consolidated plan of mutual fund scheme to consolidation mutual fund, government business and India infrastructure finance plan approved by central government. Interest in joint ventures of government से related. Gold bonds में important है that we have to with sovereign gold bond scheme which is now discontinued, I think so. In it, if you state in the redemption, then entire capital gain exempt. I have seen people have made good money in 8 years and paid zero tax because they state till exemption, redemption. If they transfer in between, then tax will be there. Transfer of a capital asset, conversion of gold into electronic gold receipt or conversion of electronic gold receipt into gold, it is exempt from tax. Transfer by way of conversion of bonds or debentures into shares of the company. This is exempt. Conversion of preference shares into equity shares of a company, exempt. Artworks, firm to company. If you succeed your firm, partnership firm, by a company and satisfy the conditions that all the assets of the firm relating to business immediately before succession become assets and liabilities of the firm. All the partners immediately before succession become shareholders in the same proportion in which capital accounts issued in their firm. Partners do not receive any consideration or benefit directly or indirectly other than by allotment of shares. Here you have to take care. If you have to distribute some money, then before starting the process, you distribute the money in the firm. Don't do it in the company. Aggregate shareholder of the partners is not less than 50% for 5 years. Transfer of capital asset by a private company, unlisted public company to limited liability partnership is also exempt. Conditions, assets and liabilities immediately before conversion become assets and liabilities of the LLP. Shareholders of the company immediately before become partners of the LLP and their capital property is limited partnership in proportion to shareholding in the company. Shareholders do not receive any consideration. Here, very important point, we have seen in certain cases, the company had some free reserves or share premium or whatever. The chartered accountants planning the conversion, by mistaken, they took the money to the current account of partners. This is a violation. If company cannot distribute share premium to its shareholders, if a company cannot use share free reserves to its shareholders or limited uses are there, so you have to follow that procedure there. In the company, you have to wipe out first share premium, free reserves, and then conversion. Otherwise, if you convert and you treat share premium as a current account, it's a violation and exemption will go. huge exemptions has been gone. Aggregate profit sharing ratio, total sales turnover 60 lakh earlier, 60 lakhs current year. Total value of assets in any of the three tax year does not exceed 5 crore rupees. These limits need to be reconstructed. There is a issue in private company where profitability is high and they want to convert to LLP, but they are not able to do it because of this condition. So these are the conditions. Stock lending scheme of the stock exchanges. If you lend your shares, it is not a transfer. Reverse mortgage scheme, it is not a transfer. Business trust is not very important for us. Withdrawal of exemption, three conditions. होल्डिंग सब्सिडरी में विड्रॉल होगा अगर 8 years से पहले वायलेशन होता है तो. सेकंड, अगर फर्म टू कंपनी में there will be withdrawal of exemption if violation of conditions happen in specified period. And similarly coming to LLP में, तो अगर वो वायलेशन होता है तो exemption will go. Nature of capital asset almost similar, security listed in recognized stock exchange not more than 12 months. Unit of a unit trust equity oriented 12 months, any other set 24 months, slump sale 36 months. Inclusions in period of holding, same provision which we have here, that asset held by the previous owner period has to be added in any situation. So need not to discuss this provision here too much. Long-term capital asset, same definition. Computation. Computation is again similar to current regime. Full value of consideration, expenses, no indexation, cost of acquisition, indexation only in case of land or building, that too acquired before 23rd July 2024. Then only, what are the amounts allowed? Expenditure incurred, cost of acquisition, cost of improvement, long-term capital gain arising from land of building acquired before 23/7/2004, index cost of acquisition only for the purpose of computation of tax. For capital gains, again cost of acquisition. There was a problem current year when people went to file the return. They found that the surcharge has been charged because capital gain will be taken full value of consideration minus cost of acquisition. Tax will be calculated full value of consideration minus indexed cost if lower. So in many cases, they have negative tax values. So tax on capital gains was not there. But capital gains has to be included in normal income as normal provision. And if surcharge is applied, then it is applied. There is a provision called distribution of money on reconstitution of home, in which some assets are taxed. There were rules earlier, detailed rules for attribution of capital gain. Now detailed rules will have to become in the times to come. Any interest claimed on house property, self-occupied property, claimed, allowed is not important, claimed will not be allowed. Still a question is there that if interest can be added to cost of acquisition, yes, it can be added. It will be added under new law also, provided you did not claim the self-occupied interest on capital in the return of income. You opt for new regime, you didn't claim the interest, you can add the interest to the cost of acquisition still, and under the new law also. So any sum paid as securities transaction tax is not deductible. This is something very much demanded with this year budget, that this should be done away with. In the case of non-residents, if shares in the company or Indian company are acquired, then they are given benefit of the foreign exchange fluctuations. So all index cost, full value are to be converted into the foreign exchange, and then capital gains is to be computed, and then it has to be recomputed as per rupee value. So this is the non-resident special provision. Now we come to the cost of acquisition. Goodwill, any other intangible asset of a business or profession, trademark, brand name associated with the business, any other intangible asset, right to manufacture, produce, process any article or thing, right to carry on any business or profession, tenancy rights, stage carrier permits, loom hours, or any other right. If purchased, then purchase price, otherwise zero. If acquired by the previous owner by paying a price, then price paid by the previous owner. If he didn't pay any purchase price, then zero. Any other right I want to explain. This has been added in recent Finance Act, I think so, number 23 or 24. Any other right, actually, there was a provision, mostly used in metros, that transferable development rights have not been taxed due to some court decisions because it has no cost of acquisition. Now they have included it in here. So now TDRs are taxable because there will be cost treated as zero because of the provision. So you have to be very much clear. Financial assets, shares, etc. If you purchase it, then the purchase price. If bonus, then nil. If rights, then acquisition price. If rights announcement, then announcement price plus acquisition price. Same provision which is currently we have. Any other asset, if acquired, HR 2001, the fair market value at the option of the SSE, fair market value cannot exceed its stamp value as on 1/4/2001. So that has to be kept in mind. So 1/4/2001 is the base date. Just a minute. Certain modes of acquisition. Again, if you acquire it from the previous owner, then cost for which previous owner acquired the property. Previous owner is the person who is the first person who paid by mode of acquisition other than, suppose your father received property under gift from your grandfather received from great grandmother, then previous owner will be the father of great grandmother if he has purchased the property. But you have the option of 1/4/2000 to 2001. Similarly, amalgamation company का वो जो आपका है वो उस तरह से हो जाएगा. Rights of a partner in LLP formed upon conversion cost of acquisition shares in the company. Company acquired by non-redemption of gold capital unit of business does not very much of use of our life. Consolidating plan. Segregated portfolio. There is a formula that we were talking about in the initial. X is equal to A into B. So you have to put values A, B, C, and you find the value. So you need not to read the long lines and interpret it and then understand it, then make a formula or go to some textbook. You have to simply put that values in this formula and you get the values. Shares in resulting company as a result of demerger, then again you determine the cost. X is equal to A into B into C. So X is the cost of acquisition shares in the resulting company. A is the cost of acquisition shares in the demerged company. Net book value of asset transferred in demerger. Net worth of demerged company. You have to put the figures and you get the result. Suppose you received some property for a value lower than stamp value, then it is difference is taxed under section 56 and the new law it is section 92. So if that property is sold by you, then the value taxed will be the cost of acquisition. This is electronic gold receipts, same cost. Now we come to the cost of improvement. Similar provisions as of now, that goodwill, etc. If we have incurred some any cost of improvement, then it is to be taken, otherwise it will be nil. Other capital asset 1/4/2001 key value you have to find and then add in the value incurred by you. One thing is important, that cost of improvement does not include expenditure deducted from incomes under other heads of income. Suppose some expenditure is deductible under business head, then it will not be included here. Okay. Advance money. If you have taken advance money and then forfeited it, then it shall be deducted from the cost for which asset was acquired, returned on value, and shall not be deducted from the cost of which the advance money has been included in the total income of the SSC. If you have paid tax on the advance money, then it will not be deducted. If you have not taken, then it will be deducted. Special situations. We have taken some special situations here which are present in the Act also. First is market-linked debentures. Market-linked debentures, unit of a specified mutual fund acquired on or after 1/4/2023, and there is involved transfer, redemption, or maturity of such debenture, unlisted bond or unlisted debenture which is transferred matures on or after 23 July 24. So at the time of acquisition, whatever was the law, when you go to redeem it after 1/4/2023 or 1/2024, then it will be treated as a MLD, and it will be treated as gain will always be treated as short term, gain will be treated as a normal income and added to your total income. Okay, so period of holding is not important here. A special treatment, that conversion, reconversion is not available to non-residents here. Computation, simple cost of acquisition will be deducted. STT will not be deducted. Market link debentures, which is the underlying components, the market link debentures are available. A specified mutual fund. This definition has been changed in current law also. 65% of total proceeds are invested in debt or instrument. Earlier, they've written not more than 40% something language that was covering gold mutual funds, etc. Now, only those funds which invest in debt or debt related instruments, if 65% funds are included, then it will be taxed under this section. If your asset is destructed by flood, typhoon, hurricane, cyclone, earthquake, any other convulsion of nature, riots, civil disturbance, accidental fire explosion, accidental by enemy, and if you receive money from insurance company, that money is taken as full value consideration minus cost of acquisition will be taxed. If insurance company gives money, some replacement asset, then fair market value of the replacement asset on date of receipt will be taxed. If both are given, then both will be added and taxed. Minus only cost of acquisition, no indexation. If you treat your capital asset into stock and trade, then fair market value on the date of conversion is treated as a full value of consideration, but it will be charged in the year when stock and trade is sold. And if stock is trade is sold at a higher figure, then difference will be taxed as business profit in that year. Similar provision, current 45(2). Sale of shares through depository, there was an issue that if depository transfers the shares, then who is the transferor? So its provision was brought in at that time. That transferor is the shareholder, not the depository. And how to determine period of holding and all that, for that circular was issued, circular number 704, dated 1995, circular number 768, dated 24/6/1998. Now we have to see whether these circulars will be issued or not, because these issues have not been added in the section itself. So we have to wait for that. Conversion of capital asset in a firm LLP, or suppose you join a firm and you bring capital contribution, then value recorded in the books of accounts is full value of consideration. The controversy which is going on with when I bring the land, when I building the building, whether 50C will apply or not, it will continue to go because this controversy has not been addressed under the new law. Rest is the same. Cost of acquisition will be deducted. Any expenditure will be deducted. Reconstitution or dissolution of firm. Section 9, capital B, 45(4) under the current law. Section 8, 67(1) to 67(10) under the new law. Section 8. So first, if you receive any asset on dissolution or reconstitution of a specified entity, capital asset or stock in trade, then fair market value of the capital asset on the date of distribution will be treated as full value consideration minus cost of acquisition will be taxed in the hands of firm, not in the hands of partner. First thing, reconstitution, one or more partners ceases to be partner. One or more new partners or members are admitted. In such circumstances, one or more partners who were partners of the specific entity before the change continue as partners of the members after the change. All the partners and members, as the case may be, specific will change with a change in their respective shares. So you have to be very watchful to these issues, and partners do change deed in the year without consulting their chartered accountants. So don't know whether they have changed the profit sharing ratio or all that. But if there is a change in profit sharing ratio, then it is a reconstitution of firm. So there will be double taxation. First, in section 8, in stock and trade, it is treated as business income, or capital asset, it is treated as that. Now come to the second point, section 67(10). It overrides 67(1), so this gain can be simultaneously taxed here also. Here only reconstitution is covered, not dissolution is not covered. Under the current law also, this is a controversy whether dissolution is covered. Dissolution is not covered under section 45(4). So only reconstitution is covered. In 9B or section 8, distribution is also covered. So suppose on reconstitution of the firm, the partner gets something in excess of the capital account, then it is chargeable. If capital balance is given, nothing is chargeable. If any asset is given, then there is a formula they have given that A is equal to B plus minus CV. Value of money received plus amount of fair market value of the capital asset received by a specified person minus balance in capital account. This is the amount taxable under section 67(10). There are detailed rules of how to determine various things under the current law, but we have to wait for the rules to come under the new law. Compulsory acquisition, initial compensation is taxable minus the cost of acquisition, indexation not allowed. Enhanced compensation, entire amount is taxable in the year of receipt. If any reduction is there, then the assessment will be revised and reduced amount will be taxed. That is the point. Land development agreement, same provision, current law. Individual RHF, only for individual RHF. Land building, that specified agreement shall be registered agreement. The capital gain shall be chargeable to tax income of the previous year and when certificate of completion is received. Or stamp value on the date of which a certificate of shares shall be the full value of consideration. This is the same provision. Buyback of shares. Similar provisions currently we have to pay tax as dividend, and all thing is there, and capital loss will be computed. and that will be here. Depreciable asset. If block ceases to exist, then short-term capital gain. If block doesn't cease to exist, but money received on sale of property is higher than the block value, then difference is taxed as short-term capital gain. In always, gain will be short-term, depreciable assets. Slump sale, here for long-term 36 months is required. One thing is important. Rest is the net worth, fair market value. The concept is same, which is of the current law. Section 50C, Section 78. If you transfer a land or building, stamp value is 100. Stamp value is 105. Your transfer value is 100. 100 will be taken. Stamp value is 110. 112. And stamp value will be taken. If you say that I have not disputed the stamp value before any authority, then you can ask for a reference to valuation officer, and valuation officer will determine the value. If it determines value between 100 and 112, that value will be taken. If it determines value at higher than 112, then 112 will be taken. This is the same provision as of now that we are taking. Suppose there is an agreement for transfer, and on the date of agreement, you've taken some money via check, bank transfer, etc. Then stamp value of that date. If you taken money as a cash, then stamp value of the date of registration will be taken. Other than quoted shares, same provision, fair market value in such manner the rules will become. Then we can discuss consideration not ascertainable. Then again rules will become. And now we come to the exemptions portion. Section 54, replica section 82, similar provision, residential house must be transferred, capital gain must be long term. Capital gain amount must not exceed 2 crore rupees. Then SSC can acquire 2 properties, otherwise 1 property. If if new investment more than 10 crore, then excess will be ignored. Only 10 crore value will be taken. This is the same provision, and deposit in CGS, capital gain account scheme, will be available by up to the date of filing of ITR. Second, agriculture land used by the SSE or his parents for 2 years. Land must be used for agriculture purposes. Land may be long term or short term. Same provision, section 54B. Amount of deduction, that also same, whatever amount to invest and all that. Suppose you transfer a land or building in an industrial ranking, immediately 2 years for the purpose governed by the provision is applicable by way of compulsory acquisition. Suppose your factory is compulsorily acquired, 54G or section 84 exemption you can take. But for industrial undertaking, business must be there, and investment in new undertaking must be there. Bonds. Same provision that if long-term capital asset being land or building you transfer, and within 6 months from the transfer you invest the whole or any part of the capital gains in a long-term specified asset, then that amount is not taxed, but amount must not be more than 50 lakhs in a financial year or in a financial year followed financial year. The new asset shall not be transferred or converted into money. Converted matlab loan, gift, advance, anything you should not take. 54F, section 66. Again, same individual achieve any long-term capital set, acquire a residential house, 2 crore, not own more than not 1 residential house, same conditions are there. And amount in excess of 10 crore will be ignored, always remember. When deduction will not be available, owns more than 1 residential house other than the new asset, purchases any residential house other than a new asset within a period of 1 year after the date of transfer. In 54, there is no restriction. You can purchase another residential house. Year restriction. Construct any other residential house. In 54, there is no restriction. You fulfill the condition, get the exemption, you can again construct new house. CGS allowed. Urban area to any area other than urban area, then you get the exemption under current law also, and the similar exemption is there. No change in the law, exactly no change. Similarly, you can shift your undertaking from any area to specified economic zone. Then again, certain conditions are to be fulfilled and exemption is there. Very remotely used exemptions are there. Sometimes you don't receive the money and you need time to invest. So for that a provision is there 54H in the current law, and in this law also they have given a relaxation in some cases that when you receive the money, then you can invest the money. Reference to valuation officer fair market value claimed by the CEC of the opinion is variance with the fair market value, then reference can be made only for the purposes of section for the capital gain. STCGL equity share section 111A replicated by section 196. Rate is same 20%. If we gift city, if we are transferring in the gift city, then STT condition is not there. Equity share in a company, unit of equity allotted fund, unit of business trust. Resident individual HF will get the slab benefit. If other income is below the basic income limit, then that amount will be deducted and only balance 20% will be there. Equity oriented fund includes ULIPs now also. So that will be taxed. Tax on LTCG, which 12A, 12.5%. No rebate. Rebate is not allowed, 87A. Slab benefit will be available. Non-resident will not get the benefit of that reconversion and all that. Tax on LTCG on property. Earlier, there was some issues in understanding the language. Language was very much clear. But now, they have simplified for the formula, excess income to be ignored, income tax to be. So first you compute income tax at 12.5% without indexation. Then you compute tax at 20% with indexation. And A minus B, if 0, yeah, negative, then nothing to be ignored. If A minus B is suppose 100 rupees, then 100 rupees to be ignored, only B amount is to be paid. This is only for the tax, not for the purposes of capital gains. Again, I repeat, capital gains will be computed for the purposes of total income, say full value of consideration minus cost of acquisition, minus cost of improvement, minus expenses on transfer, no indexation. That amount will be added to your total income. Whether you pay tax or not here is not important, because you didn't pay tax due to that grandfathering of the provision, because you acquired property before 21st July 2024. The scheme changed, so government allowed some leeway. So you don't pay tax on capital gain, but capital gain will be included as it is in the total income. And if total income exceeds the certain amount, then surcharge and cess or all provisions will apply. As per that provision, this capital gain will not be eligible for rebate. Short-term capital gain, long-term capital gain, both are not eligible for rebate. So even if your total income is less than 12 lakhs, when includes 5 lakh capital gain, you have to pay tax on 5 lakh capital gain. That's important. So that is all There is hardly any departure from Income Tax Act as we have seen through the journey. That is all from my side. Thank you. Any queries, welcome.
Hello.
Hello.
Yes, sir. Sir, there are questions which we would like to take up. I would like to read the questions.
Okay.
For claiming the exemption under section 54F, for the purpose of determining the date of investment in the under constructed property, whether date of registration of the under construction property is to be considered or the date of possession of the property is to be considered, since there is generally a timing difference between date of registration and date of possession.
We have judgments on both sides.
Sir?
So we have judgments on all the sides, so you can take help of a judgment.
Judgment. Okay. Based on that judgment, either of the option has to be exercised. Right,
You
sir.
have to look into the area where you live, where ITT judgment is in a favor.
Yeah. Right, sir. Sir, subsequently, one of the participants, there were around 1,000 plus participants, sir, for the session. So it was a great interactive session. So whether the capital gain can be included in the total income for eligibility of IT rebate is the question.
No, 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 no. IT debate is gone.
Rebate has gone. Okay. Then there is one more question on sale of land and building purchased on or before 22nd July 2024. Now, if the benefit is there in the case of indexation taxation for the purpose of section 54 deduction, so do we consider the capital gain computed as per indexed capital gain or without indexation benefit?
Without indexation.
Without indexation, that would be there, right?
For taxation purposes, you will calculate with indexation and then 54. But for ITR purposes, you will take without indexation then 54.
Okay. Okay, sir. Then further question also is there regarding the judgment of Supreme Court incorporated in the new act. So do we have to refer those judgment while interpreting those new law? Is a very interesting question. So I would also like to know on that.
Which judgment you are talking? Hardly any judgment is included. So you have to take reference from old judgments still.
So whenever we are interpreting the new law, still
Hmm.
we can take the interpretation of the old
Yeah.
law wherever required. Yes. Okay, sir. That would be of great help. Then point of taxation of capital gain under the joint development agreement for small units, say 200 square yards, where the JD is not registered and the completion certificate is not mandatory. Then what would be the point of taxation is the question, sir.
Then it will be in a general law, not that 45(5)(a) will not be available in the case of unregistered agreement. So point of taxation will much depend upon how you draft the joint development agreement, whether you give only development rights whether you give possession, whether you give everything. So there are huge controversial issues there. So you have to see the drafting of the agreement properly, and then point of taxation will be decided accordingly.
Very, very validly answered, sir. What is the tax treatment of EMD received against the capital asset if it is forfeited by the buyer in case of in situations where negotiation is generally failed?
Then it will be, if you offer to tax, then no problem. If you don't offer to tax, it will be reduced from the cost of acquisition.
Okay. Okay. Uh, will it be treated as a capital receipt or not? Is there any change from the old law and
No,
new law? The,
no,
the definition, I think so. The member requires to know about the capital receipt, whether
no,
it
no,
has changed in the
no.
yeah. Okay, great. Uh, a resident who has purchased residential property in 2011, that is 2011, for 50 lakhs and paid 20 lakhs and the rest of the bank loan and remaining amount by the bank loan for 10 years. Now the same property is sold for 2 crores, whether he is eligible to claim the interest paid to the bank while calculating the indexation cost of interest paid on the remaining principal amount.
You can, if you do, you have not claimed deduction under section 24B.
Okay, so the answer to question is 24B. If you have claimed 24B, then you
Look,
can,
there is a change in the law.
yeah,
Earlier there was nothing, no such thing. So prior to that period, interest is can still be claimed. The
right.
cost from the date of change
Mm. Mm. Right,
till date cannot claim. If you have claimed under section 24B, if you have not claimed 24B, you can still add to your cost of acquisition.
right, sir. So those were the limited number of questions we had, sir. Uh, uh, Technical team, should we conclude the session after my formal vote of thanks? Are there any questions to be taken? Okay. Uh, thank you so much, sir, for your wonderful insights on the capital gain and corporate restructuring. So all the members, more than 1,000 member attended the session. I'm sure it was a fruitful discussion. And as we call in Sanskrit that Antah Asti Prarambha, this is the end of the old law, that is Income Tax Act 1961. But this is the new beginning, that is Income Tax Act 2025. So the end is the new beginning. So you are having wonderfully elaborated, sir, a lot of uh, 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 the you have elucidately explained the provisions of new act which will be enacted from 1st of April 2025, 2026 rather. So on behalf of Direct Tax Committee of ICAI, I really thank you for your valuable time and sharing the valuable knowledge
And
also
any
to the
query,
members.
people can ask me on WhatsApp, no problem.
Yeah. So, so nice of you, sir. Thank you so much for that as well. And on behalf of the Direct Tax Committee, I formally propose a vote of thanks to you for your valuable guidance. Yes,
Thank you.
thank you so much, Direct Tax Committee, for giving me an opportunity also to share, to moderate this session. Thank you. Yeah, thank you.